Welcome to the B.F. Anderson Technical Report for July the 1st. You know, we all have to stay steeped in reality. Bear markets exist. They've happened in the past. They'll happen again. So I just wanted to kind of go over a few of the historic numbers just so that you have your ears up and you understand the possibilities of a bear market and how important trend following is, because as far as I can tell, after 40 plus years of doing this, it's really the best defenses that you have. In other words, the best defense is a good offense. So if we go back and look at past bear markets, I think it's interesting to note, and what I did is I took $1 million at the beginning of a bear market, and at the bottom of the bear market, where did you stand? Just to kind of give you a concept of what's going on. Bear markets can be extremely difficult. So in 1973, if you had $1 million, it dropped to $500,739, or a 49.93% decline. In 2000, which was the dot-com boom, even worse, you dropped to $494,897, or a 50.51% decline. 2007, it gets worse. 57.69% drop brings $1 million down to $423,066. 1937, $1 million dropped to $400,107, or roughly 60%. 1929 was the big doozy, which was the Great Depression. $1 million dropped to $108,141, or 89.19%. So as we get into the examples of what I would really recommend you pay attention to is, we use a trend following indicator called the trend lines. And if you note here, I took the 2000 drop, and you can see here that we broke below the 35-week moving average for 2 weeks. You know, most people wouldn't have gotten out. Maybe you should have gotten out. I think you should have been raising cash here, because look what happened afterwards. Now, you're not going to get out at the top, and you're not going to get in at the bottom, but you are going to salvage a large position of your portfolio if you use this particular indicator. Here's the S&P 500. I went ahead and used that for the year of 2008, which was the financial crisis. You can see here it even worked out a little bit better, where you broke below that 35-week moving average for 2 weeks. You would have gotten very defensive, because this is what happened following that particular break. So I'm just simply saying there are defensive mechanisms that we can use to protect ourselves from bear markets, because a bear market is going to be inevitable. It's just a question of when. So let's look at where we are right now. Well, no bear market, thank goodness, because right now the NASDAQ is in a very strong uptrend, actually making new highs, holding very nicely above that 10-day moving average, very constructive. This is the mid caps. Now, what's bothering me a little bit about the market right now is we're not getting 100% participation in all the indexes. Some people are doing well, like the NASDAQ and the S&P 500, but the mid cap stocks and the small cap stocks and the New York Composite really aren't participating. This index is basically moving sideways. Here we have the New York Composite. Basically, this is all the stocks on the New York Stock Exchange, basically moving sideways. Here's the small caps, same story, moving sideways. But when we get to the S&P 500, you can see that's where the action's at. So it's somewhat of a large cap market. So this is where the most positive returns are taking place. Now, as we get into the Russell 2000 Growth ETF, which is small cap stocks, the growth sector, you can see here been somewhat moving sideways, trying to break out. So basically, since February of this year, small cap stocks or growth stocks have been underperforming the market. But in the long run, the growth stocks are really where you want to be. You want to be in the Amazons of the future, the Walmarts of the future, the Microsofts of the future. Here is our indicator that we're just showing the historic nature of. This is the 35-week moving average for the NASDAQ. NASDAQ's hitting a new high. This is a bull market. We are not trying to say that we are in a bear market or approaching a bear market. This is a very strong, powerful bull market right now. You should take full advantage of it. Here's the S&P, the same particular indicator. You can just see how perfect this up move has been. This is a very powerful uptrend. Okay, here we have the aggression index. This is where we're comparing the NASDAQ to the consumer staple stock. So, aggressive versus defensive, and this is a ratio. As you can see, it deteriorated since February, came down to the 40-week moving average, held, and is actually working its way back up and broke out above this basing area. So this is looking very constructive. So the growth stocks are starting to show some strength. Now here are our three economic indicators. Interest rates continue to deteriorate, head lower. We're at 1.44% on the 10-year Treasury note, which is making actually, with all the talk about inflation, why is it that these interest rates are breaking down? Now here's the price of oil, continues to stay in an uptrend, currently around 73, did get up a little bit more than that, but oil continues to be strong. And as we look at our top five, we're going to continue to see the oil stocks are continuing to lead this market in a way. The financials have somewhat rolled over, moving sideways, but that has to do with the fact that interest rates are not giving them what they need. Now, new lows, no problem at all. We're in good shape there. Now, on the inverted yield curve, we're seeing the yield curve somewhat flattening out a little bit here, pulling back, but really no serious downtrend and definitely no inversion. So we really are not seeing a recession, but we are seeing maybe the possibilities of an economic slowdown. We'll see that in some other indicators. Here's the sentiment readings for the bull-bear ratio. Continues to kind of stay in an elevated area, but a little bit more neutral. Not real elevated, though. Seeing some improvement there. Here we have the put-call ratio, same scenario. We continue to stay in greed. We've been here for a long time, ever since really the beginning of the year, and there's just a tremendous amount of optimism right now. Okay, now when it comes to inflation, again, this is the TIP bonds, which is inflation-protected treasury bonds as a ratio to your traditional treasury bond. And you can see that the market really, since the pandemic, has pretty much discounted inflation for quite a long time. But you can see here a peak in the ratio, a lower peak, now a lower low, a lower peak, a lower low, trying to kind of rally a little bit here. But what it's basically saying is that the market's probably more concerned with deflation than it is inflation. So be very careful about what you hear on the news, because everyone's talking about inflation. The data is not supporting it. Now, this is junk bonds. Again, this is somewhat of a deflationary look. This is where we take junk bonds as a ratio to treasury bonds. As long as it stays in an uptrend, says that the junk bonds are doing better than treasuries. Well, you can see here we're starting to get somewhat of a rollover here. So again, it kind of confirms some of the other indicators we're looking at. I think the market's discounting an economic slowdown, not hyperinflation. Now, the volatility index is in really good shape here. As you can see here, back prior to the pandemic, you can see the kind of readings we were getting on the volatility index. Well, we have finally, after getting a big spike and staying elevated, we're now down here. Now, this is very positive for risk assets, because low volatility means good things for risk assets. Now, again, as we get into the top five, you're going to continue to see this oil story. With Marathon Oil, we got the gap up, we got the flag formation. Now, we had somewhat of a shakeout here. However, it's held. But as you can see here with the 10-day moving average, it's just kind of waffling around. It's not really making new highs. I have a lot of trouble, to be frank with you, of getting excited about the oil industry. It just doesn't seem like it has a lot of potential. But the stocks have been strong. So here's Continental Resources, another oil exploration company. You can see the shakeout, kind of came out of it, broke out to a new high, now somewhat consolidating. We'll just have to see on this. Here's Callon Petroleum. We took a stab at it, but we decided just to exit around in here, and it's continued to hold, but I'm just saying that, be cautious with these oil stocks. They can be incredibly volatile. Here's Crocs, which is rubber shoes. I mean, here we got the gap up, flag formation, starting to develop a new uptrend. There's a lot of companies out there that we're noticing that kind of cater to this market. This is somewhat of a millennial thing. Here's Devon Energy, same story, but we got the gap up. It kind of failed, came down. So even though we're seeing a lot of oil stocks in our top 5, I would continue to be cautious about this area. If you have any questions, give me a call. Thank you very much.